Hi, everyone. I want to go over topic one assignment as an example and walk you through some of the calculations. The first question on this assignment has to do with just categorizing accounts and making sure that you understand which the different types of accounts and which financial statement they go on. So you'll just drop down from each of these to select the category that the account is in. Cash is an asset. That's probably the easiest one of the whole thing because everybody has cash and it is used in the business. It's a resource used, it's an asset. Assets are on the balance sheet. Accounts payable is a liability. Anything payable is due to be paid and we owe it. Liabilities are also on the balance sheet. Common stock, that's an equity account. Equity accounts are also on the balance sheet. Anything with the word expense is going to be an expense account. Expenses are on the income statement. Net sales, that's a revenue account, and that is also on the income statement. Only revenues and expenses are on the income statement. Here's another expense. Income statement. Short-term investments, that's an asset. And just like we set up here, assets are on the balance sheet. This stockholder's equity, let's see, it's also on the equity statement. Okay, they don't give us that option. I was going to make sure because that amount is also on the equity statement, but then it flows over to the balance sheet. So I want to make sure that wasn't a curveball there. All right, gain on the sale of land, that's a gain, and that's on the income statement. Retained earnings, that is an equity account. Retained earnings will show up on the balance sheet as well as that equity statement. Dividends payable, that's also equity. Actually, dividends payable is a liability. The dividends account is equity, but this is a payable. So just like up here, we had payable, we're due to pay that. That's going to be on the balance sheet. Accounts receivable, that is an asset. We're due to receive money from customers. That's on the balance sheet. And short-term debt, that's a liability. Same thing as an accounts payable, really, short-term debt. The short-term portion of a mortgage or something like that, the short-term portion also goes on the balance sheet. All right, so that's number one. Let's move on to number two. In number two, we're given information and we're asked to fill in for the differences. So the thing you need to understand here is the accounting equation. And if you know part of that equation or everything but one thing, you can solve for what you don't know. So let me pull up the whiteboard here. Let's see if I can find it here. All right, and so just to remind you, assets equals liabilities plus equity. And in that equity category, there's a separate calculation for the equity. And so equity is beginning retained earnings minus dividends plus net income. And that gives us ending retained earnings. And equity is paid in capital plus retained earnings. Okay, that's what the equity amount entails. So on this problem, we're given, like for firm A, we're given assets, liabilities, paid in capital. So we've got assets, liabilities, we've got this paid in capital. We're given dividends and retained earnings. Dividends, and then we're giving beginning retained earnings. So we have to work backwards here if you look at this accounting equation, we know assets, we know liabilities, and we know paid in capital. So we can solve for retained earnings. And that ending retained earnings goes there. So then we'll know that, and that we can solve for this. So it can be a little tricky because you have to do a little two-step process here to figure out what to solve for, and then do the second part. So looking at this one, we're given assets, liabilities, capital. This is 12/31 is ending, 1/1 is beginning, and dividends. So let's figure out that first part of the equation first. Let's go back over here. So assets, they told us was 409. Liabilities, they told us was 214. Paid in capital, they told us was 88. And we're going to solve for ending retained earnings. So to solve for that, let's just pull the 214 and the 88 over here. And that's going to give us, well, let me punch it in here. I have the answer right here in front of me. 409 minus 214. Okay, that's going to give us 107. Well, 107 as ending retained earnings. Okay, so that's going to be that number. Now we just need to try to move this over. We just need to plug it into this formula here. So beginning retained earnings, we were given that. That was 87. We were given dividends. We're going to subtract out the 54. We don't know net income, so that's going to be a big question mark. And that's going to equal this 107. So when we solve this one, let's take the 107. And then we're going to get 74,000 would go in here. Okay, so let's plug that back in over here. So we found the 107 and we found the net income of 74. All right. Make sure we didn't miss anything there. All right, so we got that. So you can kind of see the way that these are related, and you can finish the firm B and firm C. So for firm B, you're going to have to solve for paid in capital first. You know assets, you know liabilities, you know ending retained earnings. You just have to solve for the capital. So you're going to use this formula here. You know assets, you know liabilities, you know beginning retained earnings already. You're going to solve for paid in capital. All right, next, we're asked to calculate the differences between current assets and current liabilities. For Gary's TV, we need total assets, ask for operating income, lots of different questions based on this one set of data here. Now, with the first thing I would do, I'll zoom in a little bit here. I would go through and categorize these accounts. Interest expense is an expense account. So it's going to go on the income statement. So we will need that for our income amount. Paid in capital is an equity account. Accumulated depreciation is an asset, but it is subtracted in the total assets amount. Notes payable, that's a long-term liability. Expense here, inventory is a current asset. Accounts receivable is a current asset. Depreciation expense. Land is a fixed asset. Retained earnings, equity. cash, current asset, cost of goods sold is an expense, expense account, equipment, fixed asset, income tax expense, expense account, accounts payable liability, and net sales is revenue. So let's see if I can highlight on here. For current, the first thing that asks for, calculate the difference between current assets and current liabilities. So current assets would be merchandise inventory. See, I can't really, let's just highlight it. So we got 138 and we've got 52 accounts receivable. So add up those and we've got cash 24.5 and I think that's it. So if we add up the 138 and the 52 and the 24.5, we get 214,500 for current assets. And then let's just subtract out the current liabilities. And we only had one, 45,000. So that's going to be 169,500. All right, so we just pulled the current assets, which were merchandise inventory, accounts receivable, and cash. And then we subtracted out the current liability of accounts payable to get the difference between current assets and current liabilities. So total assets is going to be current and fixed assets. So we've got accumulated depreciation is going to be subtracted from our total. The accumulated depreciation is the decrease in usefulness of an asset. It's going to be related to this equipment down here. So let's revisit that. Let's add up everything first and then subtract that. So our other assets, let's see. We've got our current stuff. So we're going to get that inventory again, accounts receivable, land, cash, equipment, and then add all those up and take out the accumulated depreciation. So if we add up 138, 52, 51 for the land, 24.5, 42, and then let's subtract out the 6,200 accumulated depreciation. That is a contra asset account. We get 301,300. All right, operating income. This is basically the income statement, most of it. We're going to take net sales first. Income statement has revenues minus cost of goods sold minus expenses. We've got rent expense and depreciation expense. Those are going to be our two operating expenses. And we're asked for operating income. So this is also known as EBIT, earnings before interest and taxes. So we're going to wait on the interest and the income tax expense. So let's take the 470 minus cost of goods sold minus the rent 13,800 minus the depreciation 3,100, and we get 201,100. Next, part D says calculate net income. So we're going to go ahead and take off those interest and taxes as well. So take the 201,100 minus 6,100. Still in my calculator, so I'm just going to take that out, and minus 78,000 for the income tax expense. We're still positive, so that's a net income of 117,000. Average income tax rate. That's calculated by taking the income tax expense divided by earnings before taxes. So we're going to take this 201 minus the interest expense only, 6,100. So 201, 100 minus interest expense. We get 195,000. And we're going to take 78,000 divided by that 195. So formula for average income tax rate is going to be the income tax expense of 78,000 divided by earnings before taxes, which was 195,000. We get a 40% rate. Be sure not to put 0.4 right here because that percentage sign would just multiply by 100 to move that decimal and get the 40%. And then the last part says if 24,000 of dividends have been declared and paid, what was the beginning balance of retained earnings, January 1st? So this one we're going to work backwards. Let's go back to the whiteboard here. And let's just clear it. On this one, we're asked to find the beginning retained earnings and beginning retained earnings plus net income minus dividends gives us ending retained earnings. And we knew 3 of these things. We're solving for beginning. We knew net income. We calculated that. That was the 117. And we know dividends. They gave us that, 24,000. And we know ending retained earnings. That was also in the list, and it was 166,500. So for solving for that one, what plus 117 minus 24 equals 166,500? So take 166,500, and I'm going to get 73,500 is my beginning retained earnings number. So 7350. All right, so let's make sure we're good there for number 3. Number 4. We're given information again, asked to prepare an income statement, statement of equity, and balance sheet, and then answer the rest of the questions. All right, so you could go through here and categorize these. We need to pull out the revenues and expenses first for our income statement. We always prepare the income statement first. So our sales, we've got 204. We've got cost of goods sold. Take that out. So 204 minus the 122. Minus expenses. They group them all together for us. Minus income tax. Well, actually, interest first, 5,300, and then minus income tax. So sales minus, or revenue, or sales minus cost of goods sold, minus selling, general, and admin expenses, minus income tax, and minus interest expense. All that. We're going to get 36,200 for our net income. Let's plug that into our income statement. I like to do it on paper first and then plug it in to the income statement. So net sales, cost of goods sold, it's going to be a negative because we're subtracting it. And that's going to be called gross profit. And then we're going to take out our selling, general, and admin. Expenses. What did they call that? There it is. I kept skipping over it. And that was 32,000. Again, in negative because we're subtracting it. And that's going to give us our operating income. We're going to take out interest. And that was 5,300. And then we're going to, and that's going to be earnings before taxes. And then we take out taxes. And that was 8,500. And this is going to be our net income. All right, so 36.2 is what I got on my paper, what we've got on our income statement. All right, for the statement of equity, we are going to take under paid in capital, we're going to start with common stock. So I think I can just type this in. Yep. And common stock, they told us right here was 98,000. That's our paid in capital. And then retained earnings, we had beginning, let's pull it, January 1st, 12,100. We're going to add net income. I just figured that out on the other page. It's not in the problem. You have to get it from the income statement. And minus dividends. Negative or a minus 18,100. All right, and then ending balance. Let's see, that's all it's wanting on that one. Okay, so I got 128,200. Next is the balance sheet. And we're going to list out from those numbers up top, assets first, in order of liquidity, cash is first, then accounts receivable, and inventory. So let's do those first. Cash, 63,000. Well, is it going to let me do it? Here we go. I was still in the check my work. Let's do cash. And accounts receivable is 10,000. And merchandise inventory, 38,500. Okay, so we've got total current assets here. Make sure, I don't think there's any others. Equipment is fixed. We're going to put that in just a second. So here we're going to have equipment. And then we're going to have accumulated depreciation, less accumulated depreciation. Equipment was 121 and accumulated depreciation 51.7. Okay, we got to net these two together. 1 minus 57 is 69,300. Okay. Liabilities, we list in order of time as well. The most current go first. So accounts payable will go first. And we've got 14,600. for accounts payable. So let's put that one on there first. All right, and then let's see what other debts we've got. Long-term debt, $38,000. Got our total liabilities here. For equity, we're going to have common stock. And I think that was 98. Let's make sure. Yep, 98. And we're going to have retained earnings. And that was from the other statement that we had. Let me go back and pull it from here. It was 30,200. Okay, so it automatically calculates. We've got 18800 and we've got 18800. We've balanced. That is lovely. Let's check our work, make sure we didn't mess up any formatting. Looks good. All right, I think we have one more part to this question. Okay, company's average income tax rate. We did that in the other problem. It's going to be that tax expense divided by earnings before taxes. So we're going to pull tax expense, that 8,500 divided by earning before taxes. So 8,500 divided by 447. And it says round your final answer to the nearest whole percentage. So that's going to be 19. Okay, interest. We've got interest expense. Let's find it. We're going to do 5,300 divided by long-term debt, which is 38,000. So 5,300 divided by 38,000. That's going to give us our interest rate. And this one says round to the nearest whole percentage, so 14%. Par value per share. That's going to be our common stock. We have 9,400 shares, and the value is 98,000. So we just take 98,000 divided by 9,400 shares. And this is rounded to the nearest whole dollar. So we're just going to put 10. I got 10.43. So I'm going to put 10. And then dividends. Asked company's dividend policy. What portion of the company's earnings used for dividends? This one, we're going to take the amount of dividends divided by the net income. So dividends, 18,100 divided by that. 6,200 net income, 50%. There we go. Let's check it. And we're good on that one. Let's make sure to make note of the rounding. Some of them may say 1 decimal, 2 decimals. Some of these all say whole percentage or whole dollar. All right, and the last one. Let's see what we've got here. Rudy owns and operates furniture store. Balance sheet totals are indicated. We're going to indicate the amount and effect of each transaction. Then we're going to calculate net income, changes, and true or false. All right, so see if I can try to get all this on one page here. All right, so we've got August 1st. The beginning totals assets equals liabilities plus equity. So we've got 730 on the left, 730 on the right. All of our assets came from either borrowed money or revenue or investments by the owner. They've got the first one done for you. Borrowed $14,000 in cash from the bank. Cash goes up, that's an asset. Debt goes up, that's a liability. So we've got our new totals here. August 7th, bought merchandise inventory valued at $16,000 on account. Inventory is an asset. It goes up. We bought it on account. We did not borrow the money. I mean, we did not pay cash. We borrowed the money. Right. Net, and it automatically calculates our totals. So we can verify 318, 442, 760. So we're good there. Paid $8,000 cash for operating. If we paid cash, cash goes down. Liabilities are not affected, and expenses come out of equity. Just like we did on the income statement a while ago, we did revenues minus expenses, and that net income went to the equity statement. So it eventually comes out of equity. Received $55,000 in cash from sales of merchandise that had cost of $36,300. So we received cash, $55,000, but our inventory went down $36,300. And if that's the case, the profit would have been $18,700. I'm not really sure how they want us to put this in here, but maybe just put zeros here. Probably separate. Let's try it. We'll do check my work. All right, so we've got $770,700, and let's make sure we balance over here. We got $770,700. All right, paid $10,500 owed on accounts payable. Cash goes down, and our liability goes down because we paid some of it off. Collected $19,500 of accounts receivable. We got, we received cash and accounts receivable went down. So actually this one's going to be 0, 0, 0, because we basically swapped one asset for another. We collected cash, but we also reduced our accounts receivable, what we're due to receive from our customers, because we received it. Next, we've repaid $10,000 to the bank plus $200 interest. So we paid $10,200. Of that, $10,000 was our debt, and $200 was an expense, interest expense. And paid the owner dividend of $4,000. Cash goes down, dividend, and equity goes down. All right, so at the bottom, we'll verify that we balance. Okay, and then let's check and make sure if it likes what we put in. All right, looks good. Okay, what was the amount of net income or loss during August? How much were total revenues and total expenses during August? So total revenues, let's just go back here and look. They would be over here in this section because revenues increase equity. And we had this sale right here. Cost of goods sold was $36,300. So 55 minus 36,300 gives our gross profit. So Actually, our revenue would be the 55. Oh, forgot to do that. Now, 55. Total expenses. I'll have to go back and get those. Again, they're going to be over here in this column. We've got 8,000. We've got the 36.3. We've got the 200 interest. Now this dividend, that's not an expense, that's an equity thing. So I'm not going to do that. This is going to be net income. Let's see if that's what it's wanting there. You probably didn't want it in a negative. So let's fix that. All right. What were the changes during the month of assets, liabilities, and equity? Well, the good news is they already have it calculated. We just have to take the difference between the beginning and the ending. So 730, 746. So assets went up 16,000 from the beginning to the ending. I'll write that down. 16 for assets. Liabilities, we take beginning of 288. Liabilities went up 9,500. And equity, take beginning and ending difference, 6,500. So net change in assets, 16. Liabilities and equity. All right, which of the following statements are true? Revenues decreased equity. Nope. I already know that's wrong. Revenues increase equity. Interest is a cost of doing business. Yes, it is. Dividend is a cost. No, dividend is a decrease in equity. It's not considered an expense or a cost. Cash balance will be affected by paying off an accounts payable. Yes. And collecting accounts receivable. Yes. One you receive cash, one you pay it. When money is borrowed from the bank, total assets and liabilities go up. Yes. Because when you borrow money, your assets go up and your debt goes up. So let's do this one more time. Make sure we're good here. All right, all looks good. So hopefully this will help you with your topic 1 assignment to get through that. Your numbers are going to be different, but hopefully you can pause the video, rewind, and go back to it as much as you need to get to the right answer. Have fun doing it, and let me know if you have any questions.